The Aquest Podcast, Funds Industry Conversations.
Hello podcast listeners and welcome to the Aquest Podcast. If you're new to the Aquest Podcast, do hit subscribe on your preferred podcast providing channel. If you're a decent person with a kind heart and a good soul, do make sure to hit like and to share the podcast so we can spread the word to the wider community. For this episode, I'm joined by Dennis Slattery, who is a risk expert from a fund management company background. We have a wide-ranging conversation on all things risk-related, from the mindset of the good risk professional to NextGen Fund Management companies and the kinds of services and level of risk analysis that they're going to perform. We chat about the good practices that you tend to see in the best performing fund management companies. And we even talk about what the next gen of risk professional is likely to look like with their coding skills and their knowledge of technology and fintech. So it's had a very wide-ranging conversation on all things Manco and risk-related. Enough of the teaser, let's get on with the show.
The Aquest Podcast, Funds Industry Conversations.
Hello, Dennis, and welcome to the Aquest Podcast.
Good morning, Danny. Nice to be here.
It's great to have you. I've introed you as a risk expert. Is that a fair description?
Yeah, I suppose we're dealing in an environment where things are changing quite rapidly, and certainly I come from a risk background. I've also had some compliance experience in the funds industry. So I'll accept that today, Danny. Thank you.
I tell you, are risk experts born just like taxmen and clampers, or do they develop over time?
I think experience is very important. Certainly, if you can have investment management experience, front office experience in terms of managing assets along the way, I think it's absolutely important. A lot of what we do in the fund side is focused on meeting regulatory risk requirements, but at the end of the day, you must never forget that you're responsible for monitoring that everything is being done in a very safe manner and that investors get the best outcomes. So it's there's quite an awful lot of strands to risk, so it's very important to have quite a bit of experience in the background, touching off various asset classes and different experiences in terms of operational risk and quantitative side, etc. So quite a bit in it, yeah. And
so I know we're going to chat about fund management companies and the approach to risk there, but just generally, Dennis, you said you have a range of experience before you ended up in the risk area. I guess that helps you then to understand better what it is that you're looking for.
Absolutely. I mean, I would have started my career working for a very small to mid-sized fixed income firm, and it's very much kind of a family-run business. And while you might have had responsibilities in one area, you were expected to kind of help out in others. So you got a well-rounded early kind of feel for how trading is done, how portfolio management is done, and all the interactions, and indeed the plumbing of investment management, which is very important. So in terms of trade flows, from the point in time where a trade is actually put on to the settlement cycle, how interactions are done with the various delegates, etc. You learn that from a very early stage, and knowing how these things are put together and the infrastructure and the plumbing of Wall Street, so to speak, having a kind of a feel for that is very important. But it's also important in terms of ensuring that you have kind of a broad feel for various types of assets, and of course, things are evolving all the time. We have Bitcoin now. We have lots of things going on in the marketplace in terms of different asset classes and how they behave. Having a feel for those and having a feel for the various different points around those asset classes, which need to be taken into account. So it's not a one size fits all. You kind of have to think of every situation and every product and every investment strategy differently. So that can be a bit of a challenge, especially in an area where everybody's looking to have something different, and investment managers are in particular trying to diversify by using different types of instruments to get the same economic exposure to a particular investment. And the investment banks haven't stopped in terms of the level of innovation in relation to those things. So it's hard for risk managers to stay on top of all these innovations and make sure that they work and that they're safe and that they're compliant, etc.
And so when you step from another role, whether it's kind of front office or even legal, and you come into a risk role, what's the mindset then of a risk expert, a risk professional? My experience, I guess, when I was in the central bank is, the central bank is all about a risk-based approach. So it's very much, I thought, always asking what could go wrong, what could go wrong here? And if I identify what could go wrong, then I can think about how we get ahead of that and either manage, mitigate, monitor, eliminate the risk.
Yeah, I think you put your finger on it. I think that, in terms of stepping back and taking a look at we talk about risk profiles, and certainly the regulators are very interested to know what your appetite for risk is. So, it's very important to start from there and decide, well, if we're going to be responsible for the management of these investments, what do we feel comfortable with? And that there's several strands to that question. On the investment side, you're looking at various items such as how sophisticated or complex is the product in terms of whether it's diversified or concentrated, whether it's using leverage, whether it's using lots of derivatives to achieve that leverage, the geographical context of that product, and even things like how it's going to be distributed and the types of investors that are going to be invested in it. And then in terms of your risk assessment, things like who you're dealing with, which is very important, because at the end of the day, the portfolio management function will be delegated or mostly delegated. And you want to make sure that the investment teams and the businesses that you're delegating to are properly resourced and staffed and have the right procedures and backing behind them. So it's no one size fits all, but in terms of ensuring initially, at least, that your approach to risk is properly, I suppose, quantified. And doing that means having the right appetite statements in place to make sure that you're not taking on risks that are unidentified at the start, that you don't have mitigants in place for the risks that you do have identified, and that you have systems in place to properly monitor and stay on top of these things. So quite a bit in that. And of course, we know from recent CP86 and even before then that the importance is of buy-in from the business and the board in particular, that they're knowledgeable about the types of risks that are being incurred, understand the types of risks, and are able to kind of get a feel for how much risk the firm wants to take, and if that risk is being taken, how is it properly monitored and quantified.
Certainly, the language around risk, the familiarity that let's say boards of directors have now, it's a much bigger part of the agenda. It's a much bigger part of the conversation than it probably was even 3 or 4 or 5 years ago. I think there's much more focus on risk and then how a firm approaches it and manages it.
I think you'd see that as well in board makeup, Danny, in the sense that you want to have complementary backgrounds and skills, and it's useful to have people with investment or trading or portfolio management expertise on boards that can ask the right questions and certainly come up to speed on new investment strategies quickly. Yeah.
In addition to your gender diversity and everything else, skills diversity, very, very important.
Oh, yeah.
But tell me, the two key attributes, I think, for the risk officer are one, always to ask what could go wrong, and then the second is it to not be afraid to be the party pooper, to be strong enough to say no when you need to say no, or do you get to leave that to the compliance guys and let them be the bad guys?
No, well, there's a third one, Danny, which is this. There's an awful lot of information coming into management firms and fund companies, and with it being a delegated business model, the risk manager isn't is a second line of defense in so many ways. So it's the information that is coming in has to be challenged. So I would say that in addition, a good risk manager needs to be able to verify the information that's coming in, because it's not enough being told by the portfolio manager, let's say, that, for example, they're adhering to their best execution policy, for example. I just throw that one out there. You need to be able to verify that from time to time and assess that. So that's obviously quite a bit of work. But on your point, in relation to being able to stand up and say, this smells, or this is something that we should discuss at board level as to whether it's right for the business to sign up this client, or to if it's a new investment strategy, to make sure that you go through the right types of debates. And the risk team should definitely be a central point in any debates around new risks that are being introduced to the firm. Indeed, yeah.
And I think you referenced there constructive challenge or challenge. I don't know if you said it was constructive. Let's assume you're going to try and be constructive, but challenge. Verifying information that you're told, not being overly dependent on one source of information. If that source is let's say the portfolio manager, the investment manager, who may be somewhat conflicted, but to have other sources and to be alive to the risks and to the challenges.
Well, for example, Danny, one of the important things is to have an independent source of data coming into the management company, so that you can assess for yourself what's going on and draw your own conclusions. I think that is the case across most funds companies in Dublin, but it's absolutely important that you can assess things for yourself based on kind of independent sources.
I was going to say ask you about good practices in fund management companies. So when you think about the fund management company that is really at the top of the class when it comes to its practices and how it approaches risk management, what are the kind of things you'd expect to see in that business? Is it independent data sources, own risk managers that are doing their own thing and, not dependent on information from service providers, that kind of thing?
Yeah, and we've touched off a few of them already, but certainly I take the independent data feed as being a kind of a hygiene factor. I think that's without a doubt. I wouldn't even see that as a best practice as such. But some of the things I do think, from my experience, fall into the whole best practice off the top of my head, is that this idea that the management company's risk function, the permanent risk function, is very much an extension of the risk management function at the delegate. So that, in some ways, management companies, there's two ways of running a risk team or risk management function. One is where you're merely the police and you're telling people what they can and can't do. The other is where you also have this collegiate relationship with the investment management team and the risk management team on the portfolio management side. And that's quite helpful, because if you're seen as the police only, there can be a time where you're not properly consulted pre-trade on a particular move. And that's obviously not good, and it's got potential financial implications down the line and reputational issues. But if you can build a strong relationship where you're seen as a resource, knowledge base, whereby investment managers and portfolio managers are calling you up and saying, look, we're thinking of doing this. What do you think? And even if it is a no, you should be able to have a discussion around how it can be achieved. So rather than just saying, no, you can't do this, Mr. Portfolio Manager, it's very important to say, look, tell us what you're trying to do, and we'll talk about how it can be done within the rules, or whatever it might be. So that kind of collegiate relationship with the portfolio management team, I think, is one of the things that's will set you apart.
Yeah, I guess as the good fund management company in a competitive world, particularly here on the third party Fund Manco side, that element of collegiality or that sense that you're a valuable resource as opposed to a compliance cost. And adding value must be a very important distinguishing factor as much as everything else in terms of trying to grow a third-party Manco business.
Yeah, and it's not just an issue for third-party management companies either, Danny. It's also captive, whereby, there'll be a risk. Maybe there's there's a risk DP based in Dublin, and there has to be that line back to the portfolio management team, whereby he feels part of the overall team, not just sitting out in the domicile of the fund and performing a duty that's really something that's required, not seen as a proper value add resource in terms of these day-to-day issues. So that's a challenge for everyone, I think.
And so that's a great point. When it comes to third-party fund management companies compared to captive Mancos, what's the difference in approach or the difference in mindset in one business versus the other? Because we're quite familiar with our third-party Mancos, but on the captive side, is there a challenge around being the one with the constructive challenge, given that you might be the person located in the offshore of where the fund is and not necessarily at the heartbeat of the portfolio management team?
Yeah, and I think that's critical. I think the economics of it, and you need to have your designated persons integrated into what's going on in London or New York or wherever the investment decisions are being made, and I think that's key. I suppose one of the big things is you're part of a larger group when you're in the captive side, and I suppose being able to you're going to be outnumbered in terms of when you're sitting at the table in relation to discussions around compliance and risk matters, and your home office may not fully understand what the local requirements and the regulations are. And again, we go back to this point of ensuring that the people performing this duty in Ireland, they need to be able to stand up and be counted for, and need to be able to get their point across in order to ensure that decisions that are being made elsewhere are being configured in a manner that are compliant here for these types of regulated funds. And you may say that that's something that will also exist in third-party management companies, but at the outset, investment managers are they're actually seeking your expertise. It's not as passive. So the process of hiring a third-party management companies is you want access to the European marketplace, and you want a regulated product, and you're actually buying the services of a company who knows how to do this properly, has done it before, etc. The other thing to mention is independence. It's easier to show independence in a third-party management company setup than a captive side, but each have their own pros and cons, if you ask me. Yeah.
And so if you're in a captive Manco, and you're drawing your sources of information from the same place that your investment management sister company is, you're using the same systems to run the same analysis, is it hard then to demonstrate you can do something to add value when you're, as opposed to kind of replicating what's already been done in London or New York or wherever HQ is?
In an ideal situation, you'd have your own data flow, but that's going to perhaps add up. And indeed, most sophisticated institutional managers have invested millions in systems. So piggybacking off the main group system is not, in my book, a problem as such. Where you can make up for that is that if you're reading off the same page, you want to make sure that you're asking the right questions, and indeed requesting and formulating and commissioning your own types of reporting that's suitable to ensure that you're meeting your responsibilities. So it's all about the questioning and the challenge, and I suppose the central bank is very big on evidencing these things. So you need to be you need to ensure that when you are challenging, that you can back that up and through documentation to show that you are. And that can somewhat be a mitigant to not having the independent data feed coming in. But as I said earlier, I think it's important for managers to have their own independent assessment of what's going on in funds.
Yeah, and absolutely, having that evidence is crucially important, because you can imagine if you are a supervisory team at a regulator and you sit down with a firm, of course they're going to tell you what they think you want to hear. We put the clients at the center of everything we do, and all of that. But it's your ability to demonstrate, well, this is where we've taken action in the best interests of our clients. This is where we've, been hit in the pocket to make sure that our clients were not affected. And where you've got evidence of that, or you've turned down a proposal or a client or whatever because it wasn't right for your business, or you weren't happy with how it would treat clients, that's evidence, and that's very powerful evidence. But outside of that, as I said, if you're a supervisory team, it can feel like you're being told what they want you to hear, but without the backup, there's not a lot of value to it.
Yeah, and I think that first example there of examples of where you've turned away business, I suppose a lot of firms, third-party management companies, would get a lot of inquiries in from investment managers that you just wouldn't do business with. They're looking for access to regulated product, but they're not credible outfits, and you could get 4 or 5 of those types of inquiries every week, but you wouldn't give it much thought, and you might just say, well, sorry, no is the answer, but you wouldn't document that. So it's, you're always looking for evidence that you've turned away business, but there's a lot of business being turned away simply because you want to be dealing with credible delegates, and but it is important to be able to show that and keep records of where you're turning away business. The other point I'd make, Danny, is not always about turning away business. Sometimes business comes in and you conduct your due diligence, and the firm is credible, but there's areas of concern, let's say, and you might very well have that conversation with the delegate and say that, look, you really need to address these issues before we can consider launching a regulated product. And I've certainly been in that situation many occasions. And it could mean having to turn around and say, look, we're going to put a hold on this for some time. And there's obviously commercial and financial implications of that. But that's part of the due diligence side, and it's part of the board. The board needs to have an understanding of that, and making sure that you have adequate timelines in terms of funds launching and onboarding funds and that, to make sure that there's proper amount of time available to really get under the bonnet of who you're dealing with.
Yes, and all of that demonstrates, that the Manco is discerning in how it does business, which is a way of evidencing that that they are looking to do the best for the business and for the clients that they're going to serve in terms of the investors and the funds that they manage. One of the things we touched on briefly there was we talked a little bit about third-party Mancos and captive Mancos. And one of the things that I think has me tearing my hair out for the last while is what I see anyway as my perception that when you look at how ESMA will deal with any discussions around delegation for fund management companies, there seems to be this perception that captive Mancos good, third-party Mancos bad. And if you look at the letter that ESMA sent to the Commission, I guess it was this time last year, on the AIFMD review and the priority items, definitely got that sense that their belief was captive is the preferred and maybe the best model, and anything else was lesser. Whereas actually, both UCITS and AIFMD equally provide for both models. We have both here in Ireland when we have a substantial third-party Manco business at this stage. And to my mind, they're both equally valid models. They're different. The risks associated with both are different, but neither is necessarily better than the other. And certainly this sense that I get that ESMA thinks captive is better, I don't think it necessarily stands up to scrutiny, because you can easily see the risks that exist in a captive business that don't in a good third-party Manco, like the independence that you get from a third-party Manco. Am I wrong, Dennis? Am I too sensitive to this? Have I been in the trenches too long?
it could be that ESMA are thinking purely in the line of the larger, well-known institutional investment managers who are, commercially and economically, it makes sense for them, and they have the requisite resources and can put them in place in Europe to fulfill their business objectives. But if you take smaller investment managers with brands that don't necessarily stick out, who are looking, who basically see their core competencies as running money, it makes sense to go to a specialist in that marketplace, in that jurisdiction, who can help you structure your investment offering, number one, because that's a competency in itself, and there's a lot of strands to it, but also able to assist in the various areas of getting to know your market in terms of distribution, even things like compliance and how things work. These are things that investment managers are looking for more and more. They want these extra value adds, and the next generation Mancos will be the ones that are able to service their clients in many, many ways, not just in hosting and structuring, but also in the areas of distribution, even things like investor relations, which is very important. I mean, even in terms of investors who are looking to access these products, there's quite a bit of hand-holding required, even for institutional investors, to actually even fill out subscription forms. And there's quite a bit of work that management companies, and quite a lot of good that management companies can bring on the investor side to make sure that that's a smoother process. And even things like fact sheets and compliance and things like that, you might say they're fairly mundane, but every month rolls around and there's quite a bit of work and needed to be done. And it's not always the investment manager in its home office that's in the best position to do this type of work. So distribution, sales, marketing, investor relations, compliance, there's a lot going on there. So for ESMA is thinking probably, in terms of these firms, they're all sitting under the one group. The flow of information might be somewhat easier, but in terms of the demand for investment product in Europe, a lot of these investment managers will need a lot of help in terms of creating and marketing their product in Europe. And the only entities that can help in that regard are these third-party management companies. There's also the issue of the fact that third-party management companies see what's going on across all their clients. They will be probably dealing with multiple administrators, depositories, and service providers. They're able to get the best rates. They see what rates are around town. They can negotiate better that from that standpoint based on their overall AUM. So if you're thinking in terms of, and ESMA should definitely be thinking in terms of investor best outcomes, it's hard to deny that there's the ability of third-party management companies to get best outcomes simply because the expertise is there, and certainly in terms of keeping expenses down, third-party management companies should be well placed to do that.
And thus endeth the party political broadcast on behalf of third-party Mancos. But tell me this, I did like your phrase NextGen Mancos. Is that your own, or is that a term of art that I haven't heard before?
Well, only insofar as my experience is that the best management companies are doing more for want to do more for their clients. So if you take a management company that's got a big presence, a global presence, let's take a US or Asian investment management firm. They're already doing business with you here in Europe, but they might want to do something offshore, or they may want to do something in the United States. The product specialists reside in that third-party management company, and there's expertise there on a global basis to help them, not just, as I said, with fund structuring, but with all the aspects, all the non-investment management decision-making aspects associated with that. And they can be, these next-gen Mancos can very much be a one-stop shop that way, I think.
Yeah, good phrase. I like it. I'm going to use that from now on, NextGen Manco. And I certainly think from a regulatory and an ESMA perspective, I think it is time to look at and consider separately captive Mancos and NextGen Mancos and understand that they are equally valid but different, and there might be different risks associated with them. But to legislate and guide for both rather than to try and regulate one out of existence, which I don't think is fair, and I don't think is the right approach. And I think when it comes to substance, I think that discussion is over. The CP86 Dear CEO letter, things have moved on. So I think it's now not so much about boots on the ground, but about Mancos, particularly third-party Mancos, doing what they do, but better. And you're right in the NextGen Mancos, the broader offering and service, the ability to add value. And of course, what will happen is that ability to, pick up the phone to the Manco and ask about new product that you're interested in launching and how you're going to market, or whether it's on the risk side and, is this particular investment acceptable? And if not, how can we structure it in a way that is acceptable? All of that kind of value add will become the norm, so that if you're a Manco that doesn't do it, you're going to quickly be left behind by your competitors, because as I said, the baseline will be to get this level of support. And by the way, as Mancos, you probably won't get paid for it in the future, because it'll just be an expectation as this is what Mancos do.
Yeah, that's true. And it's also a much more interesting way of life for risk professionals. I know I'm talking on behalf of risk professionals, but if you're just a passive hosting business, these days you want to be able to attract the best and the brightest on the compliance side, the risk side, and the DP side, etc. So the fact that you're operating in a manner that's there, that you're a problem solver, is very important, because and you have a wide array of investment strategies and funds and clients on your books. I think it's more inclined to attract the best and the brightest, because it makes for a more interesting workload, let's say, and you're seeing more. And I think risk professionals in particular, especially those on the fund risk side, but also operational risk side, they want to see a little bit of variety to the work. They want to be thinking about portfolios and assets and instruments, and that's, if it's a captive and it's a set of long only equity funds in a developed market, and obviously there's still risk monitoring to be done, but it's not going to be as interesting or as dynamic for a captive manager as, say, a third-party management company. But you could have risk professionals as well who want a quiet life and want a relatively, a much smaller amount of funds to monitor, for instance. So a captive will suit more in that instance. But it does depend.
Nice serene existence.
Yes.
Before we wrap up, one last question, just around fintech and the use of technology by fund management companies in the industry generally. Is this what you see all firms doing? Like, is there no future in spreadsheets and throwing bodies at a challenge? Is it all about how you use tech, either build it or buy it? Scale and do things better.
There's a few points on that, but one of the first ones is we're in an industry where there tends to be quite a lot of regular, frequent, daily tasks, and they're all kind of replicable. So it's very much suited to systematizing and automating and digitizing that workload on the risk side, but not just on the risk side, but on the operational side, where you have NAVs every day, where there's various the metrics that have to be looked at. But you may be dealing with lots of delegates. You want to be able to aggregate, and you want to be able to look through, and you want to be able to compare and look at trends and that. So there is a trend, but I don't know how successful it is yet in terms of digitizing the various work processes in this industry. What I would say on the risk side, and if there's any risk professionals listening, is to go and learn to code, and no matter what age you are. Most, especially on the liquid alternatives side, risk managers with coding skills are really de rigueur, that people want them now. They want to hire. And you're finding with the new coding languages, if systems are built off them, that you'll find risk people, instead of dealing with IT development sides of the business, you're able to get in there yourself and tweak the codes to make sure that that you're having a solid view of what's going on, and you're adapting it on a day-to-day basis. So and we've seen quite big transactions as well, announcements around private equity and technology in the fund space over the last while. There's a definite trend there. So whoever does this first in terms of getting things to a place where there's more tech solutions built in will be the winner out of all this, if you ask me, because it allows again, going back to this idea of attracting the right talent. You want that talent focused on the right things. If they're focused on stitching together data every day to make sure that they can view things, that's obviously not right. But there's information coming in from all kinds of sources in the funds business, multiple sources at the one time, that needs to be understood. And it's still, in my view, across all firms, a big challenge to get that right.
Wow. Well, let's wrap it up there, Dennis. We got NextGen Mancos. We got risk professionals with coding skills. We've got every base covered now. So thanks very much for your insights, Dennis. Very, very useful, and plenty to mull over.
You're very welcome, Danny. It was a pleasure.
It's great to have you, Dennis. And thank you, listeners, for tuning into this episode of the Aquest Podcast. We'll catch you next time. Thanks very much.
The Aquest Podcast, Funds Industry Conversations.